Hello, like many of you, I work a regular 9 to 5. I invest on the side, I follow the markets after work, and I try to make sense of what's happening without overreacting. Lately, markets have been moving up and down a lot, and if you're investing right now, you might be wondering, is this just a normal correction or is something more serious starting to happen? In this video, I will be sharing 5 signal framework I use to tell the difference so you can think more clearly instead of reacting emotionally. This is ThinkWealth6789 and welcome to my channel. Before we jump into the 5 signals, it is important to understand why the market is behaving this way right now. Even with all the volatility, the S&P 500 tracked under GSPC index is still up around 19% over the past 12 months as we speak now. That tells us the market wasn't collapsing, it was cooling from very strong levels. But at the same time, we are seeing slower hiring, inflation staying sticky, tariff uncertainty, and shifting expectations around interest rate. Still, the mix of slower hiring, tariff uncertainty, sticky inflation, shifting monetary expectations, and geopolitical tension is making investors nervous. So before reacting emotionally, let's first understand the difference between a correction and a crash. A market correction is roughly a 10% decline from recent highs. Corrections happen because markets move too fast. Valuations stretch, profit takings kick in, expectations normalize. They are comfortable, but they are completely normal, healthy, and often temporary. While a crash is something else entirely. Crashes are fast, deep, driven by fear, typically more than 20% down in a short period. And they are usually tied to what investors call a systemic collapse, when multiple parts of the financial system experience stress at once, not just short stock price. Corrections are pauses while crashes are breakdowns. So how do we know which one we are facing today? That's where the 5 signals framework comes in. Professionals don't guess. They watch 5 key signals. Number 1, price behavior. Number 2, liquidity and funding stress. Number 3, earnings and business conditions. Number 4, economic foundations. And number 5, sentiments and positioning. So let's break each one down clearly. The first signal is how prices are falling. Correction price actions declines are gradual, selling is orderly, buyers still appear, and volatility rises, but not wildly. While crash price actions show sharp panic drops, multiple big rate days, assets across category fall together, and volatility spikes rapidly. Right now, the current pullbacks looks orderly, not panic. This is still fix a correction, not a crash. And the next slide, I'm going to show you the example chart of the gold trading in the past 10 years, where it shows no panic sell-off, only price correction with each time moving slightly higher than ever versus on the right chart, the vertical collapse in 2013, where gold feels almost 30% that year, which broke the long-term trend lines. Signal number 2, liquidity and funding stress. This is one of the strongest crash indicator. When liquidity dries up, even good companies struggle. Warning signs include widening credit spreads, stress funding markets, banks tightening lending, sudden spikes in borrowing costs. During real crisis, Wall Street institutions rush for liquidity, not debate. Credit freezes before stock collapse. And today, we are seeing some tightening, not systemic stress. So signal number 2 suggests a correction, not crash. What about signal number 3? Talking about earnings and business conditions. Crashes typically follows earnings collapse, not just bad headlines. Where earnings go, market follow. Businesses still show earnings resilience. Multiple sector cut guidance happen during crashes. Similarly, revisions trend sharply downwards and profits warning spike during crashes. In 2026 so far, earnings are mixed, not falling off a cliff. Air infrastructure, energy, and manufacturing are holding. Singapore banks remain resilient. If this were a crash setup, we would already see broad earnings deterioration, and we are not, and that's very thankful. Signal number 4, economic foundations. No economic collapse without warning. Key foundations include employment trends, wage growth, consumer spending, manufacturing indicators, and credit conditions. In today's world, 2026, hiring is softening but not collapsing. Consumer spending is slower, not crashing. Tariff add friction, thanks to Trump, but not disaster. Supply chains remain stable, no major credit shocks. If the economy were breaking, we would see clear coordinated deterioration. And signal number 5, sentiments and positioning. This is one of the most overlooked signals. High optimism often leads to weaker returns because expectations are stretched. And right now, sentiment survey show bullish above long-term averages. That doesn't mean a crash is coming, but it doesn't mean market will price for perfection, making pullbacks more likely. Fear trigger crashes. We are not in fear yet. We are in recalibration. And pulling it all together, here's the 5 signal summary table. When price action is in orderly status, it shows correction. Liquidity mouth tightening is a correction as well. When earnings is mixed but stable, it is again a correction. And when the economy is slowing, not cracking or collapsing, there is still a correction. And finally, the overlooked sentiment, when it shows elevated optimism, it is still a correction. All 5 signals points to the same conclusion. This is a correction, not a crash. Unless the signals change dramatically, the evidence does not support systemic collapse. And here's the truth. Most investment mistakes happen inside our own head. People tend to have this panic selling, trying to time the market. I did as well. Following dramatic headlines, copying the crowd, selling quality early. A perfect example, in June 2023, major analysts predicted almost 100% chance of a US recession within a year. It never came. Instead, the market rebounded strongly and investors who sold in fear ended up buying back at much higher prices. This is why timing is dangerous. Here's what I call the golden rule of the market declines, and we called it the golden rule strategy and what you should do. If the economic system is intact, panic selling usually harms long-term returns more than holding quality assets. So instead of reacting emotionally, review your portfolio, strengthen quality, look at the quality portfolio, reduce speculative positions, maintain diversification, don't keep everything in one basket, keep some cash optionality, and stay invested in longer term. Quality companies recover. Weak companies don't. Look for a company with white moat. Your job is to know the difference. For Singapore and Asian investor, international capital continues flowing into Singapore. Regional manufacturing remains strong, and financial systems in the region remain stable. as well as diversified portfolio help cushion volatility. We feel global turbulence, but we are not at the epicenter of global risk. And here's the big takeaway. You don't need to predict the market. You just need a framework to understand it. With the 5 signals, you can calmly assess whether volatility is temporary or something much bigger. Right now, the signals point to a correction, not a crash. So stay calm, stay informed, and stay long-term focused. Thank you for watching, and if you found this helpful, remember to like this video and subscribe to Think Well 678 for weekly bite-sized investing insights. Thank you for watching again and staying true with me, and I will see you in the next video. Goodbye.